Ordinary people do SIPs. Smarter people invest in the companies that run those SIPs because mutual fund companies earn a fee on every single SIP year after year. Markets can go up or down, but their model is built in such a manner that they will earn their fixed fee. That's why you are seeing every big name moving towards this sector. Jio has partnered with BlackRock, the world's largest asset manager, to launch the Jio BlackRock AMC. And global financial giants like the State Street recently acquired a strategic stake of 23% in the Grow AMC. That's exactly what this video is about. In this video, we will break down the AMC business model, decode the key drivers that decide who wins this sector, rank the key players on the same metrics. Before we go deeper into the AMC sector, let's clear one common confusion first. Most people think AMC means mutual funds, but that's only one part of the story. So what exactly is an AMC? An AMC is the company that manages money on behalf of investors. Mutual funds are the most popular products AMCs offer, but they are not the only one. Today, many AMCs also manage PMS, that is Portfolio Management Services, for high net worth investors, AIFs, that is Alternative Investment Funds, and now SIFs, a newer category coming into this ecosystem. They also have gift city funds for NRIs and for those Indian investors who want to invest outside India. So now let's understand how an AMC actually makes money. An AMC's job is to manage investors' money. In return, it charges a fee for running the fund. This fee varies by product type, like actively managed funds, which typically charge more because they involve research, stock selection, and portfolio decisions. While passive funds usually charge less because they mainly track an index. In mutual fund terms, this fee is called the total expense ratio, that is TER. TER is charged on the fund's asset under management, which is total money the AMC manages on behalf of the investors. The entire TER does not become the AMC's revenue. From the TER, the AMC first pays commission to distributors and platforms such as mutual fund distributors, banks, digital platforms. These distributors play a crucial role in helping AMCs reach investors across cities, towns, and digital channels, driving inflows into the schemes. After paying these commissions, the remaining portion of the TER becomes AMC's management fee, which is the AMC's actual revenue. As AUM grows, this fee pool expands. Higher AUM, whether through fresh SIP inflows, lump sum investment, or market appreciation, directly supports higher revenue for the AMC. AUM typically grows through two channels. First is the net inflows into the funds via SIPs and lump sum investment. Second is market-led appreciation in the value of the portfolio. Once the AMC earns its management fee, it still has to fund the core cost of running the business. Broadly, these costs fall into three buckets. First, people cost. This includes fund managers, research analysts, sales leadership, and support staff. Second, operations and technology. This covers fund operations, transaction processing, investor servicing, reporting, cybersecurity, digital platforms, and day-to-day infrastructure needed to manage large-scale investor money smoothly. Third, brand, marketing, and regulatory overhead. This includes advertising and investor awareness spends, brand building, audit fees, legal expenses, and the compliance and governance framework required when you are managing public money. AMC revenue scales with AUM, but many costs don't scale at the same pace. So as AUM grows, well-run AMCs can see operating leverage, meaning profitability can improve over time, even without a big jump in additional AUM. Now let's look at the key profitability levers for an AMC. First, telescopic pricing. In mutual funds, expense ratios are structured on a slab basis. As AUM increases, the permissible TER comes down. This is known as telescopic pricing. For investors, this is beneficial because costs reduce as funds scale. But for AMCs, Especially larger ones, the fee rate declines even though the absolute asset base is larger. Second, operating leverage. AMC revenues are linked to AUM, but many costs are relatively fixed or grow slowly. Fund management teams, research infrastructure, compliance systems, and core operations do not need to double just because AUM doubles. As a result, when AUM grows steadily, revenue expands faster than costs. This creates operating leverage where margins improve over time. Third, market-linked versus flow-linked earnings. AMC earnings are not driven only by fresh inflows. Even without new SIPs or lump sum investments, if markets perform well, the value of existing portfolios rises. Since TER is charged on the AUM, higher market valuations automatically increase fee income. This makes AMC earnings partly market-linked and not purely flow-linked. In stock market cycles, AMCs can see revenue growth even in periods when net inflows are muted. If you want to go a level deeper on the why behind this entire trend, why India is seeing this wave of financialization, what's driving more households toward mutual funds, and what the big structural tailwinds and headwinds are for the AMC sector, we have covered that in detail in our video on the capital markets ecosystem. You can refer to that video for the full sector context. If we look at market share, the industry is clearly led by a few large AMCs. SBI Mutual Fund is the largest with 15.5%, followed by ICICI Prudential AMC at 13.2% and HDFC AMC at 11.4%. That means the top three together controls 40% of the industry. The next cluster includes Nippon India AMC with 8.5% and Kotak Mahindra AMC with 7.2%, taking the top 5 to 56%. Beyond that, we have Aditya Birla Sun Life AMC, UTI AMC, and Axis AMC. Among the top 10 put together, these top 10 account for 76% market share, and the remaining 24% is distributed across the rest of the industry. But you cannot invest in all AMCs as only some of them are listed. The key listed players in India's AMC space are HDFC AMC, ICICI Prudential AMC, Nippon India, UTI, Canara Robeco, and Aditya Birla Sun Life AMC. Now let's deep dive into each KPI or key performing indicators of this sector and understand how each AMC positions themselves. Also, these KPIs are chosen based on widely used measures. You may also consider other metrics too. Let's start with total AUM, because this sets the base for everything else. In AMC, scale matters because the costs do not rise in proportion to assets managed. Once an AMC reaches scale, incremental AUM adds disproportionately to profits. Higher AUM can generate higher profits for AMCs. Among the 6 AMCs, ICICI Prudential and HDFC AMC clearly dominates on scale, managing close to 9 to 12 lakh crore rupees each. Nippon India sits in the next bracket at about 6.5 lakh crore. While Aditya Birla Sun Life and UTI operate in mid-sized range of 4 to 5 lakh crore rupees. Canara Robeco is much smaller at about 1.2 lakh crore rupees, but size alone does not define quality. Let's go deeper into the AUM. Let's see the AUM mix. AUM mix is the single most important variable in the AMC business. Equity AUM earns significantly higher fees than debt, liquid, or passive funds. That's why two AMCs with similar AUM can show very different revenue yield, margins, and ROE. HDFC AMC and ICICI Prudential stands out with equity-heavy books, with equity contributing roughly 60% and 56% of AUM respectively. Canara Robeco goes even further, with over 90% of its AUM in equity-oriented schemes, making it highly sensitive to market cycles. Nippon India and UTI, on the other hand, are structurally different. Passive products form 30 to 40% of their AUM, which lowers fee yield but improves scalability and cost efficiency. Equity-heavy AMCs generally show higher margins and ROE in bull markets. Passive heavy AMCs trade lower fee yield for stability and scale. This explains why ICICI Prudential delivers exceptionally high ROE, while UTI, despite large AUM, shows more modest return ratios. Now comes the AUM growth. AUM growth does not come only from inflows, it is a combination of net inflows and fund performance. Strong performance compounds AUM even without aggressive distribution, while weak performance can stall growth despite scale. Large AMCs like ICICI Prudential and HDFC AMC benefit from distribution-led inflows, but growth can moderate if performance lags. Focused AMCs can grow much faster from a smaller base when performance clicks. The classic example being PPFAS, which scaled from about 5,000 crore rupees in FY20 to over 1.3 lakh crores by FY26. Now comes the SIP. SIP monthly inflows tell us how stable and predictable an AMC's AUM can be. Unlike lump sum money, SIP flows are recurring, sticky, and far less dependent on short-term market mood. Over time, a strong SIP engine also signals that an AMC is building retail trust, distributor confidence, and deeper reach beyond the top cities. In this set, ICICI Prudential and HDFC clearly lead with the biggest SIP engines, which gives them stronger revenue visibility across cycles. Nippon India is also in the top bracket, showing a mature retail franchise. Aditya Birla, UTI, and Canara Robeco sit at a lower base, which means their SIP book is still developing and near-term flows can remain more sensitive to market sentiment. Also, Aditya Birla and Canara Robeco having negative growth in SIP book, which is not a correct sign for long-term growth. For smaller AMCs, this is important because SIP growth from a lower base can become the biggest driver of future scale. Now comes the number of schemes. This metric signals product breadth, but it can also quietly become a constraint. In India, scheme launches are not unlimited. There are regulatory restrictions to run multiple overlapping schemes in the same category. So when an AMC already has a very large scheme count, the incremental room to launch fresh products reduces. It can sometimes mean lower flexibility and less product innovation bandwidth going forward. ICICI Prudential AMC has the highest scheme count at 143, suggesting the widest product shelf but potentially lower flexibility to add incremental schemes. Canara Robeco is the lowest at 26, which can mean a more focused lineup and relatively higher headroom for selective launches. It also depends on whether the existing suites is strong enough to capture flows. The final picture is based on total AUM scale, AUM mix, AUM growth, SIP stability, and product flexibility. ICICI Prudential Services, ICICI Prudential stands out on scale and equity-led AUM, although its wide product shelf limits flexibility for new launches. HDFC shows a high equity mix and stable SIP base, but remains more sensitive to market cycles. Nippon shows the fastest active AUM growth with a strong systematic engine, while a higher passive share limits fee yield. Canara Robeco reflects a very high equity mix and product headroom. Although smaller scale increases cyclicality, Aditya Birla Sun Life reflects a diversified mix that reduces volatility, but active growth remains slower. UTI reflects a large passive platform and strong distribution, though a passive heavy mix caps growth. Revenue yield, how much AMCs really earn on their AUM. Using revenue as a percentage of quarterly average AUM, most large Indian AMCs earn only about 0.33% to 0.53% annually on their AUM. Even when an AMC manages several lakh crore rupees, the revenue generated is only a small fraction of that number. This is why AUM movement matters so much. If AUM grows, revenue grows. If AUM falls, revenue falls. If the equity share within AUM increases, revenue tends to grow faster than the AUM. Equity heavy AMCs like the ICICI Prudential and HDFC therefore show higher revenue yield, while passive heavy AMCs like UTI and Nippon operate at structurally lower yields. Canara Robeco, despite a very high equity mix, currently shows a lower yield due to smaller scale and pricing structure. From revenue yield to profitability, AMCs are asset-light businesses. They do not need factories, inventory, or heavy capital expenditure. Once an AMC reaches scale, most fixed costs are already absorbed. As a result, incremental revenue has high operating leverage. Even small differences in revenue yield driven by AUM mix can translate into large differences in EBIT margins, ROE and ROCE over time. Revenue yield in the AMC business is thin, but AUM mix makes a big difference. ICICI and HDFC lead on yield, Aditya Birla Sun Life sits in the middle, while passive-led AMCs like Nippon and UTI operate at lower yields. Canara Robeco, equity-heavy books, has potential, but scale currently constrains yield. Profitability scorecard, operating margin. Operating margin tells you how much of the AMC's revenue turns into operating profit after day-to-day costs. In an asset-light business, higher operating margin usually signals better scalability, stronger cost discipline, and a business model that can convert AUM growth into profits efficiently. HDFC ranks first because it has strong operating profitability, making it the standout AMC on this scorecard. ICICI Prudential ranks second as it leads the group on operating margins, showing the strongest cost discipline and scalability. UTI ranks sixth because it is mid to low on operating leverage. Valuation metrics. Now let's move on to valuation and understand how growth is priced into AMC stocks using the PEG ratio or PEG ratio. So the PEG ratio adjusts valuation for growth, while the PE ratio tells you how expensive a stock is relative to their current earnings. It ignores how fast those earnings are growing. The PEG ratio or the PEG ratio solves for that by dividing the PE ratio by earning growth rate. In simple terms, a lower PEG ratio suggests valuation is more reasonable relative to growth. A higher PEG suggests growth is not fully justifying the valuation. A negative PEG usually signals declining earnings or earnings volatility, making valuation interpretation less reliable. For AMCs, PEG is especially relevant because earnings growth is driven by AUM growth, equity mix, and operating leverage. The business is asset light, so earnings can compound fast in up cycles. So valuation without adjusting for growth can be misleading in this sector. That's why PEG helps compare valuations and growth quality together. Rather than looking at PE in isolation, Canara Robeco ranks best on PEG because its earnings growth has been strong relative to its valuation, even though it is smaller in scale. UTI, HDFC, Aditya Birla Sun Life and Nippon sit in the middle, where moderate profit growth roughly matches their valuation, offering fair but not standout growth adjusted pricing. ICICI Prudential AMC ranks weakest on PEG as its high price to earning ratio. The PEG we are using here is based on past profit growth of 3 years. That's why Canara Robeco comes out as the best on PEG. It has seen very strong earnings growth in the last 3 years, but you can also calculate the PEG based on future expected growth. So when we put all these 4 parameters, that is AUM scale, revenue yield, profitability and valuation through PEG together, the picture becomes quite clear. ICICI Prudential AMC makes best on AUM, revenue yield and profitability. At the same time, it ranks lowest on PEG, which indicates the valuation looks higher when adjusted for past growth. Canara Robeco shows the opposite mix. It ranks lower on AUM and revenue yield while ranking stronger on profitability and best on PEG, largely because its past profit growth has been strong relative to valuation. HDFC AMC stays near the top on AUM, revenue yield and profitability with a mid-pack PEG rank. Nippon India AMC well on AUM while lower on revenue yield and PEG. Aditya Birla Sun Life AMC makes better on revenue yield while lower on AUM and profitability. UTI AMC makes lower on AUM, revenue yield and profitability. while ranking better on PEG. Now stepping back, the AMC sector still has a strong long-term runway because more savings are moving from physical assets to financial products. SIP penetration keeps rising and mutual funds are expanding beyond top cities. The key headwinds are market cycles, fee pressures from passive funds, and rising competition. If you want to understand this sector in the largest context of the capital markets ecosystem, watch our previous video on capital markets. It will give you full backdrop for why these rankings matter. And if this breakdown helped, hit like, subscribe, and share this video with someone tracking the AMC space. We will be doing more sector deep dives like this, so stay tuned.